Welcome back to another Iron Financial Explainer. Our primary mission here is to help you forge a completely bulletproof portfolio and, frankly, cut right through the absolute weakness of everyday market noise. I'm your lead analyst, and today we are tearing into an infrastructure behemoth that just dropped a massive, market-shaking Q2 2026 earnings beat. We're talking about NextEra Energy, ticker NEE. Now, if you're the kind of investor who demands hard, numbers-driven analysis and wants your capital treated with the respect it actually deserves, go ahead and hit that subscribe button right now. And I'm the market skeptic. Look, I hear the phrase massive earnings beat, and I'm going to be honest, my guard goes straight up. Wall Street is completely obsessed right now with anything even tangentially related to artificial intelligence or data centers. And NextEra, they are riding that exact wave as hard as they possibly can, positioning themselves as the ultimate utility backbone of the future. But when I look under the hood at the literal billions pouring out the door for capital expenditures and the absolute mountain of debt required to fund it all, I have to ask the hard question. Are we looking at a genuine long-term compounder here, or are retail investors walking blindfolded into a highly levered trap?
Okay, let's establish the absolute core of this debate right out of the gate. I want to be clear. This is not your standard, sleepy, clip-the-coupon utility explainer. Not even close. NextEra Energy is currently attempting to execute one of the most aggressive, high-wire dual mandates in the modern market. On one hand, they're aggressively expanding their massive regulated utility footprint down in Florida. On the other hand, they are simultaneously attempting to completely dominate the national clean energy and transmission space.
Exactly, and they're trying to pull off this high-wire act while proposing a staggering mega merger with Dominion Energy. We really need to strip away all the AI hype and inspect the actual foundation they're building on. With the current macroeconomic environment, where interest rates are severely elevating the cost of corporate debt compared to just a couple of years ago, these massive capital expenditures are incredibly dangerous. Are they actually building an ironclad grid capable of handling this ungodly hyperscaler load, or are they just stacking leverage on top of leverage, crossing their fingers that state regulators don't suddenly turn off the cash spigot?
Well, just look at the two sides of the NextEra coin we've got laid out here. The bull case is structurally undeniable. You are looking at an ironclad dividend and growth compounder that is literally doing the heavy lifting for the entire U.S. electrical grid. We're talking about a company that is targeting roughly 11% annual growth in regulatory capital employed all the way through 2032, assuming this Dominion deal actually goes through. That kind of visibility is rare.
Sure, the visibility is there, but the bear case is exactly what keeps me up at night. The sheer volume of cash required to simply maintain this growth rate is staggering. I'm actively looking for hidden cracks in the armor here. Are they hiding a massive cash drain trap behind this shiny, incredibly marketable veneer of AI data center announcements and a mega merger? We need to stop talking narratives. Let's get right into the actual headline numbers.
Right into it, Section 1. Headline numbers, breaking down GAAP versus adjusted.
All right, let's pivot to the drill down. This is my favorite part, where we separate structural reality from accounting fiction. We are going to conduct a totally methodical, line-by-line autopsy of these Q2 2026 earnings. And honestly, as a balance sheet hawk, this is exactly what I want to see. NextEra delivered adjusted earnings of $2.407 billion. On a per-share basis, that translates to $1.15. Compare that to the $1.05 per share from Q2 of 2025, and you are looking at a rock-solid 9.5% year-over-year adjusted EPS growth. Listen, delivering near double-digit growth in a tough, capital-intensive utility environment fraught with regulatory pressures, that is not easy. It means they are perfectly on track to hit the high end of their full-year adjusted EPS target range, which is $3.92 to $4.02. For your personal portfolio, hitting that guidance early in the year is a massive signal of structural, sleep-well-at-night strength.
Okay, I'll admit, 9.5% growth for a utility of this massive scale is serious heavy lifting. But hold your horses. You're quoting the adjusted numbers. As the skeptic in the room, I absolutely never just take the adjusted, sanitized figures at face value. Management teams love adjusted numbers. I need to see the raw, generally accepted accounting principles, the actual GAAP numbers. What's the real story?
And see, this is exactly why I push for clarity. The GAAP EPS is sitting at a massive $1.50 compared to that adjusted $1.15. That gap requires immediate scrutiny. That translates to a total GAAP net income of $3.144 billion. Why is the GAAP number so wildly disconnected from the adjusted earnings? What kind of financial engineering is distorting the structural reality here?
It's not engineering, it's understanding how NextEra structurally manages its risk profile. That gap is primarily driven by non-qualifying hedge impacts and mark-to-market adjustments. Let's break down the mechanics. NextEra holds a staggering $46.2 billion in notional interest rate swaps. They use these to lock in fixed borrowing costs against their floating rate debt, which is incredibly smart. But when the yield curve shifts, rigid accounting rules force them to mark the present value of those swaps to market every single quarter. If rates move down, the swap liability changes on paper, creating these massive, completely non-cash phantom gains on the income statement. By backing out that accounting fiction to get to the adjusted $1.15, we actually get a much clearer, ironclad view of their true underlying operating cash flow.
Moving on to Section 2, FPL, the Utility Foundation. Now let's look at exactly where that operating cash flow is originating from. This segment right here, Florida Power and Light, is the reinforced concrete of NextEra's entire balance sheet. Just look at the raw earnings power of this single subsidiary. FPL alone generated $1.412 billion in net income for the second quarter. That is a massive 67-cent per share contribution, up 5 cents from the prior year. And remember, they are doing this while operating in the 14th largest economy in the world, which is the state of Florida. Okay, it's a massive number, I'll definitely grant you that. But a utility is really only as good as its rate base and its inherent ability to manage operational costs. I need to know how much of that 67-cent contribution is actually driven by raw volume growth, people and businesses physically migrating to Florida, versus them just constantly leaning on regulators for base rate increases. Earning over $1 billion in a quarter is great, but how much shareholder capital are they literally incinerating to get that return? Let's get granular on the underlying metrics.
You want granular? Here is your granular breakdown. The true core driver of that EPS growth is a 9.3% expansion in regulatory capital employed, and it's largely fueled by organic volume. They literally added 90,000 new retail customers year over year. And operationally, this is the kicker. Their non-fuel operations and maintenance costs are more than 70% better than the industry average on a per megawatt-hour basis. Let me just explain the math for our listeners. Spending significantly less on basic, day-to-day grid operations means massive margin flow-through. It acts as an ironclad defense against inflation, so they aren't forced to constantly petition for unpopular rate hikes.
Right, the O&M efficiency is great, but please look at the capital expenditures here. $2.8 billion deployed in a single quarter. And their full-year guidance is sitting between $12 and $13 billion. That is a massive, ongoing capital drain. In the current yield environment, where long-term bond rates are still stubbornly elevated, funding a $13 billion build-out requires issuing some highly expensive debt. How sustainable is it to just keep building and building and building? Because eventually, all that infrastructure spending has to be paid for by the ratepayers, and there is absolutely a limit to how much regulators will allow residential bills to rise before the whole foundation cracks.
Well, they manage that exact risk through volume and scale. Because they are consistently adding those 90,000 customers, they can spread those heavy infrastructure costs over a much wider base. That's exactly how FPL keeps its typical residential bill roughly 30% below the national average, even while spending billions.
Okay, but let's talk about the real reason they supposedly need $12 billion a year in CapEx. The AI data center hype. Literally every utility CEO right now is promising the moon and the stars when it comes to powering these hyperscalers. Is this 21-gigawatt pipeline actually real, or is it just a mirage designed to pump the stock price in earnings calls? It is incredibly real, and more importantly, it's structurally reinforced. They have a massive 21-gigawatt large load pipeline, with 12 gigawatts already in advanced, serious discussions. But the most important part of this slide is the mechanics of the approved large load tariff. This ensures that when a massive tech giant wants a dedicated transmission spur built to power their new AI data center, the hyperscaler actually pays for those specific infrastructure upgrades upfront, or through a dedicated rate rider over time. This structurally protects the everyday residential ratepayer from footing the bill for Google or Microsoft's power needs. They are actively targeting 8 gigawatts of this specific load by 2032. This isn't just Wall Street hype, it's contracted, highly regulated baseload demand.
Section 3. NextEra Energy Resources, or NEER, the clean energy engine.
Okay, so we've established the utility foundation with FPL. Now let's shift our focus to NextEra Energy Resources. This is the unregulated clean energy and transmission growth engine that provides the massive upside for the stock. Adjusted earnings for this specific segment grew a staggering 18% year over year, hitting $1.291 billion or 62 cents per share. But the real structural story, The thing that guarantees future revenue is the massive 35.1 gigawatt total development backlog. 18% earnings growth in the unregulated arm is very impressive, I will absolutely admit that. But a 35 gigawatt backlog, that is just a promise to build something eventually. Break down the actual timeline for me. How much of this backlog is realistically expected to hit the bottom line by 2026, and how much of it is just some 2030-plus pipe dream? Because we all know the grid is already groaning under the sheer weight of intermittent renewables right now.
It's not a pipe dream. Most of it is medium-term, highly actionable development. Let's look at the exact composition of the 3.6 gigawatts they just added to the backlog in Q2 alone. Notice anything? More than half of the new additions, 2.0 gigawatts, is strictly in battery storage. Only 0.9 gigawatts in solar and 0.7 in wind. Now that is a critical structural pivot. Honestly, I love to see that. They aren't just blindly throwing up solar panels in the desert anymore. The underlying economics of battery storage are entirely different. See, solar generation peaks at noon when electricity is virtually free, creating that infamous duck curve that destabilizes the grid. Batteries actually do the heavy lifting by capturing that excess cheap power and discharging it at 7 p.m. when demand and peak pricing spike. You absolutely cannot power a 24/7 AI data center with solar power that simply disappears at night. This breakdown proves they are actually trying to solve real grid stability, not just farm government tax credits.
Exactly. And to prove they are actually executing in these complex environments, let's run through their Q2 line item operational wins. First up, the Duane Arnold nuclear plant. They are actively closing on 100% ownership with a firm Q1 2029 target to restart that reactor. Hang on a second. The nuclear restart is great in theory. It's the ultimate zero-carbon baseload power. But look at the U.S. history of nuclear projects. The Vogtle expansion down in Georgia was a massive, completely budget-destroying nightmare. Decades late, billions over budget, cost overruns in the nuclear sector are notoriously lethal to shareholder capital. That's exactly why you have to look at their specific engineering track record across the board. NextEra Energy Transmission just energized a massive 137-mile, 345 kilovolt line out in New Mexico, and they did it early and entirely on budget. Independent studies literally say that specific line will reduce residential bills by $13 a month by 2031. Oh, and they also just won a highly competitive consortium bid for a massive $1.6 billion, 765 kilovolt transmission backbone in Illinois. The point is, this team knows how to execute heavy, complex infrastructure without blowing up the balance sheet.
All right, Section 4, the Dominion mega deal, adding scale and, unfortunately, a whole lot of debt. I'm going to take the wheel here and investigate this proposed combination with Dominion Energy. Historically speaking, utility mega mergers are absolutely notorious for destroying shareholder value and piling on unmanageable debt. So they have formally filed the S-4 merger applications with state and federal agencies. But here's the catch. To grease the wheels with skeptical regulators, NextEra is offering $2.25 billion in shareholder-funded bill credits to Dominion customers in the near term. $2.25 billion. That is a massive capital outlay right up front. What is the actual payback period here? How many years of grinding out Dominion's rate base does it take to recoup a multi-billion-dollar hit to shareholders? It really all comes down to the brutal, undeniable math of scale. By integrating Dominion into the massive NextEra platform, they are targeting an incredible 11% annual growth in regulatory capital employed and a 9% plus adjusted EPS growth rate all the way through 2032. Listen, if they can force Dominion's bloated operations down to FPL's elite O&M efficiency level, the resulting massive margin expansion recoups that $2.25 billion well within the decade. They are essentially buying a distressed, underperforming asset and forcefully injecting FPL's efficiency into it. But you are absolutely right to question the leverage required to pull this off, which brings us to the all-important credit profile.
So let's look at the debt. Fitch Ratings maintains an A- rating with a stable outlook for the parent company, NextEra Energy, and a solid A rating for FPL. Fitch explicitly notes the highly predictable nature of their cash flows and a very constructive rate case outcome for 2025. That specific outcome provides 4 full years of regulatory certainty, including a 10.95% midpoint return on equity. Contextualize that for a second. A near 11% ROE is significantly higher than the national utility average, which sits at roughly 9.5%. That wide spread, that extra 145 basis points, is absolute gold for bondholders, providing a massive ironclad cushion for interest payments. Yeah, well, constructive regulatory environment is really just Wall Street's polite way of saying the state of Florida lets them charge ratepayers enough to cover their massive capex. But honestly, I don't just care about the letter grade. I care about the strict mathematical thresholds that will instantly trigger a downgrade if this Dominion deal or the AI build-out pushes their debt load just a little too far.
And here they are. These are the ironclad thresholds that every single balance sheet hawk needs to monitor. In my opinion, this is the most critical financial slide in this entire explainer. S&P strictly demands funds from operations to debt remain above 18%. Moody's requires cash flow from operations pre-working capital to debt to stay above 17%, and Fitch requires debt to FFO plus interest to remain below 4.3 times. Make no mistake, if management takes their eye off the ball while trying to integrate Dominion, here is exactly what happens. They breach that 18% threshold at S&P, triggering an immediate one-notch downgrade. Their cost of capital on that $12 to $13 billion annual capex spikes overnight, and that shiny 9% EPS growth target you're banking on completely evaporates. That is the primary structural risk, absolutely. No argument there. But remember, management operates with one of the strongest balance sheets in the entire utility sector, precisely so they can execute these massive capital deployments without ever breaching these exact thresholds. They know exactly where the tripwires are.
Section 5. The final verdict. Growth versus risk.
Okay, we have completely torn apart the utility foundation. We've thoroughly examined the clean energy engine, and we've debated the heavy lifting required for this upcoming mega merger. Before we give our final verdicts, let's just map out the long-term blueprint. NextEra clearly expects to hit the high end of their 2026 EPS target, which sits at $3.92 to $4.02. They are targeting a fantastic roughly 10% dividend growth through 2026. But notice this specific transition to a roughly 6% growth rate through 2028. This downshift isn't weakness, it's a highly deliberate reallocation of capital. By slightly slowing the dividend growth, they retain significantly more internal cash to fund their massive capex requirements without having to issue expensive dilutive equity. The true compounding strength of this stock is their long-term target of an 8% plus compound annual growth rate all the way through 2035. This is, without a doubt, a meticulously engineered wealth creation machine.
Right, it's an engineered machine. Assuming the Florida regulatory environment remains absolutely pristine and the Dominion deal doesn't turn into a bloated, debt-heavy nightmare of integration issues, they are essentially promising multiple decades of uninterrupted high single-digit growth and a sector that is normally known for incredibly boring flat returns. It's a bold claim.
So here is the final verdict from Iron Financial. NextEra Energy is an ironclad compounder, period. The raw operating efficiency of FPL, combined with that massive 35-gigawatt backlog at NEER, provides unparalleled cash flow visibility for the next decade. The AI data center load is not a mirage, it is incredibly real, and they are uniquely positioned to serve it with both zero-carbon nuclear and massive strategic battery deployments. If you want true structural durability in your portfolio, this is the exact blueprint you look for. And my verdict? Look, the growth is absolutely real, but so is the inherent risk. You need to watch those credit metrics like a hawk. The $12 to $13 billion in annual capex and that staggering $2.25 billion upfront cost for the Dominion merger leave very, very little room for error. It is definitely not a trap, but it is a highly levered infrastructure play that requires constant, vigilant monitoring from anyone holding it. And that officially wraps our deep dive. So are you building your portfolio on a solid, reinforced foundation, or are you ignoring the structural risks staring you in the face? Let us know your thoughts, leave a comment below, and don't forget to subscribe to Iron Financial for more relentless line-by-line market explainers. We'll see you in the next one.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.